Merger of banks, its pros and cons, or how will merger affect public sector banks? Government of India recently announced that 10 banks owned by Government of India will be merged into the four larger banks. According to the plan, the Punjab National Bank will be merged with the Oriental Bank of Commerce and United Bank of India. The Canara Bank will be merged with the Syndicate Bank. The Union Bank of India will be merged with the Andhra Bank and Corporation Bank. Indian Bank will be merged with the Allahabad Bank. The government also announced for providing rupees 55,500 crore to help these newly merged banks to extend more loans to their customers. Now, what are the reasons for merging the banks? There are various reasons cited by the government for its decision to merge public sector banks. One of them is that large banks will be able to lend more money and this will help to revive the slowing economy. Secondly, it is also of view that the merger will result in combining the administrative network, infrastructure, and assets of two or more banks, and it will reduce the operational cost and enhance the efficiency of the banks. Third is that reducing the number of banks will make it easy for the Reserve Bank of India and Finance Ministry to keep a watch on the working of the banks. Now, criticism. So there are many people who are criticizing the government's move. According to critics, the merging of the banks is due to the bad loans problem, and it has nothing direct relation to pushing the economy. According to official figures, the size of gross non-performing assets means NPA or the bad loans in public sector banks was rupees 7.9 lakh crores as on March 31st, 2019. Although the government is not projecting the present merger as a measure to tackle the problem of bad loans, but in fact, the fact is that the bank mergers in the past have been carried out to bail out the banks struggling due to the bad loans. Means the loans forwarded by the banks from which banks are neither getting any interest or capital amount of the loan from over a period of 90 days. According to critics, the financially strong banks are being merged with the weak banks, and this will adversely affect the health of strong banks. Secondly, government has assured the banks that the jobs will not be lost due to merger. Therefore, it is unlikely that the state-owned banks will be able to reduce their operational cost by getting rid of the surplus labor. Thirdly, the merger of banks will not lead to the decrease in amount of bad loans. Fourth is the merger does not address the issue of political interference in the management of the public sector banks, which is at the root of bad loan crisis. Over the years, various state-owned banks have been forced to extend loans under the political pressure, even though such loans did not always make business sense. According to government, after merger, the larger banks will be able to provide loans of the larger amounts than the smaller banks, which cannot provide larger loans due to small size of their capital base. But this cannot be justified, as in past several smaller banks by coming together have extended the large loans. In conclusion, we can say that the problem of the bad loans in banking sector cannot be addressed until the issue of corruption at higher level in the banking management and issue of the political interference is addressed. Secondly, there is need to make changes in the laws by reducing the immunities given to the defaulters and speed up and simplify the judicial system so that banks can recover their loans from defaulters within short period. However, the infusion of the additional capital of rupees 55,2,500 crore rupees by government can temporarily help banks troubled by bad loans to extend more loans without fear of getting bankrupt.